This is Brad Berry, Chief Investment Officer and Portfolio Manager with Dynamic Wealth Group. Welcome to this market and economic update. In this video, we'll provide insights on the bond market as the Fed potentially prepares for its first rate cut by the end of the year. It's no secret that bonds have struggled in recent years due to inflation and high interest rates. Bonds are particularly sensitive to interest rates. When rates rise, the price of bonds existing fall. So when rates jumped in 2022 due to inflation and rapid Fed rate hikes, bonds fell into a bear market. However, they then stabilized and rebounded somewhat in 2023. Today, many of the factors that have driven bond returns are improving. Over the next few minutes, we'll cover some insights into the bond market and why it's important to maintain portfolio diversification in the months and years to come. First, this chart shows the performance of different bond market sectors each year. Each column is a different year with bond market sectors ordered from best performing at the top to worst performing at the bottom. On the right, you can see that the Bloomberg U.S. Aggregate Bond Index is now flat on the year after struggling through April. This was because inflation was worse than expected the first few months of the year, which pushed bond prices lower. However, there are now signs that inflation is improving. The latest Consumer Price Index report, for instance, showed that headline CPI was unchanged in May for the first time since July of 2022. Certain areas, such as housing prices, remain stubborn, but removing housing prices from the core CPI resulted in a year-over-year inflation rate of only 1.9%. Of course, improving inflation does not mean that prices will actually fall for most goods and services we buy. But this is still positive for the markets because it means we are slowly returning to a more normal environment, especially once the Fed begins cutting rates. For this reason, other parts of the fixed income market have also improved, including investment grade and high-yielding bonds. Next, this chart shows the federal funds rate and the Fed's rate cut projections. Their latest meeting resulted in no change to policy rates, but the committee did revise their forecast from 3 rate cuts this year to only 1. The remaining 2 cuts were simply pushed back into 2025. These projections are very much the result of worse than expected inflation earlier this year. The market still seems to believe that 2 rate cuts could be possible, with the first one beginning in September or November. Regardless of whether it's 1 cut or 2, the point is that we are on track for the Fed to begin reversing its policy moves of the past 2 years. If this happens, it could help to support bond prices, which benefit when rates are stable and falling. Of course, the Fed's projections are subject to change, and a lot could happen between now and the end of the year. Still, this is positive for long-term investors since it means that portfolio diversification is more important than ever. Historically, bonds have helped to balance portfolios since they have the ability to move in the direction opposite to stocks. When the economy and the stock market stumble, for instance, interest rates tend to fall, which helps to boost bond prices. This pattern has not played out as much the past few years since recent volatility has been the result of inflation, which hurts bond prices. This is why 2022 experienced such a dramatic bear market for bonds. We also believe it is crucial to follow a multidimensional asset allocation approach. You see, when you rely on only one main risk-reducing ingredient to stocks, such as bonds, you can think of it as essentially riding on a 2-spoke bicycle wheel. If one of those spokes breaks, you'll have a very bumpy ride. If both spokes break, you will most definitely crash. That is why our multidimensional approach incorporates numerous risk reduction ingredients. So in years like 2022, when both stocks and bonds fell, having tactical bond strategies or arbitrage strategies or global macro long-short strategies, just to name a few, could have helped to provide a smoother return experience. Now, if inflation is truly improving, at least at the macro level, and the Fed does cut rates, then there could be a tailwind for bonds. In addition, yields are more attractive than they've been at any other time since the 2008 global financial crisis. So for both long-term investors and those who need portfolio income, including retirees, it's more important than ever to get diversified with not just stocks and bonds, but also adding in other non-correlated ingredients. Remember, we believe investors should focus on preparing for the future and not attempting to predict the future. We've only scratched the surface on this important topic, but I hope you found these insights valuable. If you are a financial advisor and would like more information on our multidimensional approach towards asset management, please visit our website at dynamicwg.com or reach out directly by emailing us at info@dynamicwg.com. If you are an individual investor, we are happy to address any questions you may have and put you in touch with a qualified advisor if so desired. Until next time, take care, everyone, and make smart, logical, and fact-based financial decisions.